Every retirement column, every real estate agent, every adult child, and every neighbor who already sold their house will tell you the same thing. Sell the big place, move somewhere smaller, take the equity, make life easier. Use the extra cash for savings, medical bills, travel, or just peace of mind. And at first, that advice sounds reasonable. Why should a 72-year-old retiree keep a house with rooms she barely enters? Why keep paying for a yard she no longer wants to maintain? Why stay in a place built for a family when the family has already moved out? Why not sell while prices are still high, buy a smaller condo, and put the leftover money somewhere safe? Because the tax system may be waiting for that exact decision. And when you sell a home in retirement, the cost is not always one simple tax bill. It can create 5 separate financial consequences. One can hit you in the year of the sale. One can hit 2 years later after the move is already old news. One can quietly change how your Social Security is taxed. One can disappear into commissions, closing costs, and moving expenses. And one may not hurt you directly at all. It may hurt your children after you're gone by destroying a tax benefit that could have erased decades of home appreciation. When you put the numbers together, a simple downsizing decision can cost more than $73,000 over 5 years. Not because the retiree bought something foolish, not because she gambled the money, not because she made some wild financial mistake, but because she sold the right house at the wrong time, without seeing the full tax chain first. Today, I want to walk through that chain step by step. We are going to use one retiree, Eleanor, and we are going to follow the money. Every tax hit, every hidden cost, every number that changes after the house is sold. By the end, you will understand why the house you already live in may be one of the strongest tax shelters you own in retirement, and why selling it too quickly can become one of the most expensive decisions of your retirement life. Before we go further, I need to say this clearly. I'm not your lawyer. I'm not your CPA. I'm not your financial advisor. This is not legal, tax, or investment advice. This is an educational example based on retirement tax rules, public IRS information, and a simplified case study. Your state, your filing status, your home basis, your income, and your family situation can change the outcome completely. So before you sell, talk to a qualified tax professional. Not after the closing. Before. Now let me introduce Eleanor. Eleanor is 72 years old. She is single. She retired 7 years ago after working in public education. Back in 1992, she bought a modest 3-bedroom home for $125,000. It was not a luxury house. It was not a flip. It was just a normal home in a quiet neighborhood. Over the next 3 decades, the area changed. The schools improved, the streets filled in, the market rose. And today, that same home is worth $525,000. That means Eleanor has roughly $400,000 of appreciation. She did not create that gain by speculating. She did not buy and sell properties. She lived there. She raised children there. She paid the mortgage. She replaced the roof when it leaked. She kept the lawn alive. And while she was living her normal life, the house quietly became more valuable. Eleanor's income is simple. She receives about $18,000 a year from a pension. She receives about $22,000 a year from Social Security. And she takes around $12,000 a year from her IRA. Altogether, she has roughly $52,000 of annual income. At that level, she's not living rich, but she is stable. Her deductions protect a large part of her income. Her tax bill is low. Her retirement is manageable. The IRS is not taking much from her. Then her daughter brings up the conversation. Mom, that house is too much for one person. The stairs are not getting easier. The yard is becoming a job. Now, why not sell it, buy a smaller place closer to us, and keep the extra cash in the bank? And Eleanor listens. Because the daughter is not being cruel, she is being practical. A smaller condo sounds easier. Less maintenance, less cleaning, less worry, closer to family. So Eleanor lists the house for $525,000. It sells quickly. Then she buys a 2-bedroom condo for $355,000. On paper, she thinks she has unlocked about $170,000 of equity. She believes she made a safe move. She believes she simplified her life. But the tax system sees something very different. Cost number 1, the capital gains tax trap. When Eleanor sells the house, the IRS looks at the gain. She bought it for $125,000. She sold it for $525,000. That creates a $400,000 gain. Now, the tax code does give homeowners an important break. If the home was your primary residence for at least 2 of the last 5 years, a single filer can exclude up to $250,000 of gain. A married couple filing jointly can exclude up to $500,000. Eleanor qualifies as a single filer, so the first $250,000 of gain is excluded. That part is protected. But the remaining $150,000 is not protected. That $150,000 becomes a long-term capital gain, and it can be taxed. This is where many retirees make the first mistake. They hear home sale exclusion and assume the whole sale is tax-free. But the exclusion has limits, and once your gain crosses that limit, the excess is exposed. Now, many people would quickly say, fine, 15% on $150,000, that would be $22,500. But the real calculation is not always that blunt. Some of the gain may fit inside the 0% long-term capital gains bracket, depending on the retiree's taxable income. In Eleanor's case, her normal income is not high. But the year she sells the house, her income picture changes, her adjusted gross income spikes. She may lose certain deductions or phase out benefits that normally help her. Instead of being taxed like an ordinary retiree with modest income, she suddenly looks like someone having a very high income year. After the regular income and deduction math is applied, a small portion of her capital gain may still fall into the 0% capital gain zone, but most of it does not. Roughly $131,000 of the gain ends up taxed at 15%. That creates a federal capital gains bill of about $19,665. Say that slowly. Almost $20,000 on a home she lived in for more than 3 decades, on growth that happened quietly while she was simply living her life. And that is only the first cost. Cost number 2, the Medicare surcharge that arrives later. This one shocks retirees because it does not arrive at the closing table. It does not arrive the week after the sale. It does not even show up as a normal income tax line that people notice immediately. It often shows up around 2 years later inside the Medicare premium calculation. That surcharge is called IRMAA, Income-Related Monthly Adjustment Amount. Most retirees do not care about the full name. They care about what it does. It raises Medicare Part B premiums, and it can also raise Part D prescription drug costs. Here's the part that catches people. Medicare generally uses income from 2 years earlier. So if Eleanor sells the home in 2026, the higher income from that sale can affect her Medicare premiums in 2028. By then, the sale is old news. She has already moved, the boxes are unpacked, the condo is normal life, and then a Medicare notice arrives with a higher premium. Eleanor's normal income would never have placed her near this problem. But in the sale year, her income jumps because of the taxable gain. That one-time spike can push her above IRMAA thresholds. So 2 years later, Medicare treats her like a higher income retiree. Her Part B premium may rise by hundreds of dollars per month. Her Part D surcharge can add even more. In this example, the extra Medicare cost comes to roughly $382 per month. That is about $4,584 for 1 year. Now, the good news is that if her income returns to normal the next year, the surcharge may not last forever. Medicare recalculates every year, so this can be a 1-year hit. But 1 year is still 1 year. That is $4,584 Eleanor would not have paid if the home sale had not spiked her income. And here is another detail retirees miss. There is a form, SSA 44, that can help some people ask for a new IRMAA decision after certain life-changing events. But a voluntary home sale to downsize is generally not treated like one of those qualifying events. Marriage, divorce, death of a spouse, stopping work, reducing work, loss of certain income-producing property because of disaster, loss of pension income, certain employer settlement payments. Those are the types of events Social Security recognizes. Selling a house because it is too big is not the same thing. So Eleanor calls and says that income was from 2 years ago. They say, yes. She says, it was one time. They say, we understand. She says, I do not make that money now. And still, the surcharge can apply. That is the sting. The decision was about housing, but Medicare reads it as income. Cost number 3, the Social Security tax spike. This one is quieter. There's no separate penalty letter, no big warning label, no envelope that says, your home sale made more of your Social Security taxable. It hides inside the tax return. The IRS uses a formula to decide how much of your Social Security benefit is taxable. That formula looks at provisional income. In simple terms, provisional income includes your other income plus tax-exempt interest plus half of your Social Security benefit. For single filers, there are key thresholds. Below the lower threshold, Social Security may not be taxed. Above the middle zone, more can become taxable. Once income is high enough, up to 85% of Social Security benefits can be taxed. Before selling the house, Eleanor already has some taxable Social Security. That is normal for many retirees. But after the home sale, her provisional income jumps sharply. That jump can push her all the way into the maximum Social Security taxation zone. Before the sale, about $10,450 of Eleanor's $22,000 Social Security benefit may be taxable. After the sale, that taxable amount can rise to about $18,700. That means an additional $8,250 of Social Security becomes taxable because of the home sale. The benefit did not increase. The government did not send her more Social Security. She did not suddenly get richer from Social Security. But the tax return now treats more of that benefit as taxable income. At Eleanor's bracket, the added tax from that Social Security increase is around $990. Compared with the capital gains bill, that may sound small, but it is still real money, and it comes from a benefit retirees often believe is separate from the home sale. It is not separate. That is the point. Retirement income sources do not stay in separate boxes on your tax return. The home sale affects AGI. AGI affects other calculations. Those calculations affect Social Security taxation. And suddenly, one decision touches areas you never connected. Before the sale, Eleanor looked like a modest income retiree. After the sale, for one tax year, she looks like a high income retiree. Not because she got a new job, not because her pension doubled, not because Social Security raised her benefit, but because one house sale changed the income number the tax system uses. The IRS does not ask whether the income was unusual. The IRS does not ask whether you will ever repeat it. The number lands on the return. Then every threshold and phase out reacts. That is how one normal retirement move can change the entire tax picture. Cost number 4, the transaction costs. Nobody calls it tax. This money does not go to the IRS, but it still leaves Eleanor's pocket, and it only leaves because she sold. At a $525,000 sale price, a 5% real estate commission is $26,250. That is already a major number. Then come closing costs, title fees, transfer taxes, recording fees, attorney fees, settlement charges. Depending on the state and county, the number can move around. But in this example, we use about $5,000. Then there's the move itself. Movers, packing, storage, utility setup, small repairs, furniture that does not fit, address changes, everything that comes with physically moving a life from one place to another, we use another $5,000. Add it together. $26,250 in commission, $5,000 in closing costs, $5,000 in moving costs. That is $36,250 gone. Not invested, not earning interest, not sitting safely in a bank account, gone. Paid to the machinery of the transaction. Now, someone may say, that is just the cost of moving. Correct, but that is exactly the point. The cost does not exist if Eleanor stays. Nobody subtracts $36,250 from her life if she keeps living in the same house. That money remains inside the home. It continues to support her housing stability. It remains part of the value she controls. Once she sells, that money exits her financial life permanently. That is why the headline number can be misleading. People say, she sold for $525,000 and bought for $355,000, so she freed up $170,000. But that is not the number she truly keeps. Before taxes, before commissions, before closing costs, before moving, before future Medicare costs, before property tax changes, the gross equity number is not the real number. Cost number 5, the property tax reset. This is the cost that can keep following the retiree year after year. It does not always happen in every state, but where it does happen, it can make downsizing feel absurd. Eleanor's old home is worth $525,000 in the open market, but because she has owned it for decades, the county may not assess it at that full market value. In many places, long-term homeowners benefit from assessment caps, homestead exemptions, senior exemptions, or tax freezes. These rules vary by state and county, but the effect can be powerful. Eleanor's home may have a market value above $500,000, but her taxable assessed value may be far lower because the assessment has been capped over many years. In this example, the county's assessed value is $285,000. Then a senior homestead exemption reduces the taxable value further. If the exemption is $60,000, her taxable assessed value is $225,000. At a 1.8% property tax rate, her annual property tax is about $4,050. Then she buys the smaller condo for $355,000. The new property is assessed at the purchase price. Even though the condo is smaller, the tax base may be higher. At the same 1.8% rate, the new property tax is about $6,190 per year. That is $2,240 more every year. A smaller home. A higher property tax bill. That is the part nobody says out loud before the sale. Over 5 years, that difference is $11,700. Over 10 years, it is $23,400. And if rates rise, the number can grow. Now, this is not universal. Some states have rules that help older homeowners carry certain assessment benefits to a new property. Some states have portability, some have special senior protections, some have local exemptions, others do not. That is why you do not guess. You call the county assessor before you sell. You ask what happens to your assessment. You ask whether your exemption transfers. You ask whether there is a waiting period. You ask whether your new property will be assessed at full market value. because the time to learn this is before the listing agreement, not after the deed records. And there's another cost here that does not fit neatly into a spreadsheet. Eleanor's old neighborhood knew her. The pharmacist knew her. The doctor was close. Her church was familiar. Her neighbors noticed when the trash cans stayed out too long. She had roots. 30 years of small connections. When she moved, those roots were cut. Maybe the condo is easier. Maybe it is safer. Maybe being closer to family matters more. But social isolation is a real retirement risk. Leaving a familiar community has a cost. It may not be a tax cost, but it belongs in the decision. Now we need to talk about the tax benefit Eleanor destroys by selling, the step-up in basis. This is one of the most important tax rules homeowners need to understand. If Eleanor keeps the home until she dies, her heirs may inherit the home at its fair market value on the date of death. That is called a step-up in basis. Eleanor bought the home for $125,000. If she still owns it when she dies, and the home is worth $525,000, her children may inherit it with a new basis of $525,000. Not $125,000, $525,000. If they sell it soon after for $525,000, the capital gain may be zero. That means decades of appreciation can disappear from the income tax calculation. A $400,000 gain, gone. No federal capital gains tax on that appreciation. But if Eleanor sells while she is alive, that opportunity is destroyed. She pays capital gains tax now on a gain that may have been erased later. Her children inherit cash instead of a home with a stepped-up basis, and that cash has already been reduced by taxes, commissions, and moving costs. If she invests the cash, the interest and dividends can create new taxable income every year. That income can affect Social Security taxation, it can affect Medicare premium calculations, it can change the tax return in ways the house did not. The home itself did not send Eleanor a 1099 every year. The cash might. That does not mean cash is bad. It means converting home equity into taxable investment income has consequences. Now let's add the 5-year cost. Capital gains tax, about $19,765. Medicare IRMAA surcharge for 1 year, about $4,484. Extra Social Security taxation, about $990. Transaction costs, about $36,250. Property tax increase over 5 years, about $11,700. Total estimated 5-year cost, $73,189. That is the part retirees do not see when someone says, just downsize. Eleanor sold a $525,000 home. She bought a $355,000 condo. She thought she unlocked $170,000, but after the full chain hits, the 5-year cost eats a huge portion of the equity she believed she freed up. Now, to be fair, downsizing can also save money. A smaller condo may cost less to heat, less to cool, less to repair, less to insure. There may be no yard. There may be less maintenance. Those savings matter. This is not a video saying nobody should ever move. That would be dishonest. Health matters. Safety matters. Family support matters. Stairs matter. Caregiving matters. Loneliness matters. Sometimes moving is the right decision even if the tax cost is ugly. But the mistake is not moving. The mistake is moving blind. The mistake is only counting the sale price and the purchase price. The mistake is thinking the equity number is the real number. It is not. You need to count the tax chain. You need to count the Medicare look-back. You need to count the Social Security calculation. You need to count the transaction costs. You need to count the property tax reset. And if leaving the home changes what your children inherit, you need to understand the step-up in basis before you sign. There is one more issue with the cash Eleanor creates. Suppose, after taxes and costs, she invests some of the remaining money. If that money earns 4%, it may generate several $1,000s a year in interest. That sounds good. And it can be good. But interest is usually taxable. It adds to income. That income may push more Social Security into the taxable zone. For retirees near certain thresholds, $1 extra of income can cause more than $1 of tax impact because it also pulls more Social Security into taxation. That is why retirees sometimes feel punished for earning safe interest. The home produced shelter. The cash produces taxable income. Again, that does not mean investing is wrong. It means the tax character of the asset changed. Home equity sitting inside a primary residence is not the same as cash sitting in an interest-bearing account. If Eleanor needed cash but did not truly need to move, there may have been other options to explore. A home equity line of credit, a smaller IRA withdrawal plan, a reverse mortgage conversation, family cost sharing, local senior property tax relief, house modifications to make the home safer. None of these are automatically right. Each has risks. Borrowing against a home creates debt. A HELOC has interest. A reverse mortgage has serious rules and costs. But the important point is this: borrowed money is generally not treated like taxable income. Selling creates a taxable event. Borrowing may give access to equity without immediately triggering capital gains, Medicare surcharges, or Social Security taxation changes. That difference is worth discussing with a professional, especially before selling a long-held home with a large gain. Now, let's talk about married couples, because the trap changes shape. A married couple filing jointly can usually exclude up to $500,000 of gain from a primary residence sale. That is a much larger shield than the $250,000 single exclusion. But when one spouse dies, the surviving spouse can face a different set of rules, deadlines, and emotional pressure. Part of the home may receive a step-up in basis when the first spouse dies. In community property states, the result can be more favorable. In common law states, the calculation can be different. This is where surviving spouses can get hurt. Imagine a couple bought a home for $100,000 decades ago. Today, it is worth $850,000. One spouse dies. Depending on the state, the deceased spouse's half may step up, but the surviving spouse may still have gain exposure if they sell later. And once the surviving spouse is no longer filing jointly, the exclusion may be smaller, the brackets can be smaller, the Medicare thresholds can be lower, and all of this can happen while the person is grieving. That is why sell the house after your spouse dies can be dangerous advice when nobody has run the numbers. There may be a limited period where a surviving spouse can still use the larger exclusion if the requirements are met. But grieving people are not thinking about tax deadlines. They are thinking about funerals, paperwork, bills, loneliness, family pressure. And by the time they feel ready to make a decision, the best tax window may already be gone. That is the brutal part. The tax clock can start while the family is still in shock. So what should you do before selling? Here are 3 steps. First, calculate your gain before you call the agent. Do not start with the listing price, start with basis. What did you pay for the home? Then add major improvements. Not basic repairs, major improvements. A new roof, a new kitchen, a room addition, a new HVAC system, new windows, major bathroom remodels, permanent upgrades that improve the property. Those may increase your basis and reduce your taxable gain. If your gain after improvements is below the exclusion limit, capital gains may not be your biggest issue. But if your gain exceeds $250,000 as a single filer or $500,000 as a married couple, you need tax planning before the sale. Second, model the Medicare impact. Take your normal adjusted gross income, then add the taxable gain from the home sale. Ask whether that number could push you into IRMAA. Do not wait for the letter 2 years later. Ask your tax professional before the sale. Ask them to model the premium effect. Ask them whether the increase is temporary. Ask them whether any appeal applies. Because once the sale is done, there may be no clean way to undo the income spike. Third, ask directly about the step-up in basis. Do not assume your advisor will bring it up. Say the words. What happens if I sell now versus if I keep the house until death? What basis will my heirs receive? What happens if I am a surviving spouse? Did part of the home already receive a step-up? How does my state handle this? This may matter more to some families than others. If you need the money to live, your heir's tax benefit may not be the priority. That is fair, but you deserve to know what is being given up. The point is not that every retiree must stay in the same house forever. The point is that selling a long-held home is not just a lifestyle decision. It is a tax event. It is a Medicare event. It is a Social Security event. It is a property tax event. It is an estate planning event. And sometimes it is an emotional event too. The real estate agent can tell you what the house may sell for. The moving company can tell you what the move will cost. Your children can tell you why they want you closer, but none of them may show you the full tax bill. And the IRS will not care that the house felt too big. It will not care that the stairs were hard. It will not care that the yard was exhausting. It will look at the gain. It will look at your income. It will look at your filing status. Then the math will happen. That is why you do not sell first and calculate later. You calculate first, then decide. Because the question is not, can I sell my house? Of course you can. The question is, what does this sale trigger? If the answer is small, then maybe downsizing makes perfect sense. If the answer is $20,000, $50,000, or $73,000 over the next few years, then you need to pause. Not panic, pause. Run the numbers. Check your basis, check your exclusion, check Medicare, check Social Security, check property taxes, check the step-up, then make the decision with the full picture. Not the version that sounds clean at the kitchen table, not the version that looks easy in a real estate brochure, the full version. Because selling your house in retirement may feel like unlocking equity. But if you do it without planning, you may be unlocking a tax chain you never saw coming. Which of these 5 costs would surprise you the most? Capital gains, Medicare surcharge, Social Security taxation, transaction costs, property tax reset. Drop the number in the comments. That tells me which issue needs a deeper breakdown next. And before you list a long-held home, do one thing. Do not ask only, how much can I get for it? Ask, how much will I actually keep after the tax system is done with it?